All right. Good afternoon. Good morning, wherever you are here and stateside. Welcome to today's ATAP webinar. Let's go ahead and get started. My name is William Uranga. I'm the Director of Talent Acquisition at Spokeo and a member of ATAP's Program Council and get to help play host for today's webinar. For those of you who are new to ATAP or attending your first ATAP event, the Association of Talent Acquisition Professionals was founded in 2016. It represents interests of the talent acquisition, recruiting, and staffing professionals at every level worldwide. And our mission is to cultivate a community that sparks innovation, engagement, and knowledge sharing for talent acquisition. ATAP is a member-driven organization. We couldn't do our work here without the over 750 individual members, as well as corporate members that we have here. Thank you so much. They're valuable to the work that we do here. In addition, we also have sponsors. We couldn't do this without great sponsors like Greenhouse, Saba, Scout, Cornerstone, Eightfold AI, People Results, Recruitix, and Smart Recruiters. We thank them so much for their sponsoring us for this year. If you haven't thought about joining ATAP or you need to renew, please do so. There's awesome value for having you as part of this organization. You can visit us and find out more information on how to either join or rejoin at www.atapglobal.org. It is a great way to network with talent acquisition professionals through volunteering or events, also including a private Facebook community. We certainly do focus on talent acquisition knowledge through the development of both white papers and webinars such as this one. And then we also advocate and build out standards for talent acquisition and advocating on talent acquisition related issues. Today is September 29th, 2020. It's Tuesday. We've got a great topic for you today, but first, a couple of important programming notes. This session is being recorded, and if you have registered for this event today, you will get a follow-up email that will include a link to the recording, as well as a PDF version of the slide deck. So please be on the lookout for that. Or know that you don't have to take feverish or furious notes throughout today's Q&A formatted session. So we do have a lot to cover. We'll look to have comments put in the chat. If you do have comments, please do share. If you have questions, please put that in the Q&A session. If you can see that button towards the lower right-hand part of your Zoom panel, please post questions there. We'll look to answer them during the session today, but we'll also be sure to reserve a good 10 or 12 minutes at the end to capture anything that we've missed or wasn't covered in today's webinar. Okay, so today's webinar is the 2021 Human Capital Metrics Reporting Mandate. And if you haven't heard about this, you're certainly at the right place today to get educated and learn about this. So we would certainly encourage you to grab a piece of paper and take some notes as well. I have the pleasure of both working with Carl here at ATAP, but Carl Kutsmode is the founder of TalentRise and is also a member of ATAP. Carl is going to be interviewing our guest today, who is Jeff Higgins. He is the founder and CEO of Human Capital Management Institute. So Carl, Jeff, welcome. Great to have both of you guys here today.
Thank you, William, and thanks everybody for joining us today. As William said, I'm here to moderate a really interactive, engaging discussion with Jeff Higgins, CEO and founder of HCMI. Jeff's a global thought leader on workforce analytics and planning. He's a committee member on the SHRM Global Standards and Center for Talent. He's been a founding member of PwC's Saratoga Institute and Advisory Council and has over 25 years helping organizations, Fortune 500 corporate organizations with their metrics and analytics, and also has a background as a CFO and HR senior leader. So today I'm going to welcome Jeff, but before we kick off, I'm just going to talk very broadly here about the new SEC human capital disclosure requirements that public companies are going to have to abide by. So on August 26th, the U.S. Securities and Exchange Commission announced we have some new requirements that that companies are going to have to start tracking and reporting in their public filings. So today, this is going to be the topic of our discussion. We're going to give you, Jeff's going to give you a little bit of history, and I'm going to turn it over to our first question here. Jeff, can you share a little bit more about what's driving this new mandate?
Sure, happy to do so. And thank you, Carl and William, for the opportunity to be here and talk about something that I'm passionate about and arguably have been chasing like Don Quixote, chase the windmills for the better part of 2 decades. And now it's happening. What are government agencies? What's this all about? Why? When does it go into effect? Who does it apply to? What does it mean for my company now? Really, lots of questions. But the bottom line is, for the first time, human capital is now entering a phase where it will be much more on a par with finance. If you think about annual reports and financial statements and all of that, it just dominates the information that gets disclosed for all public listed companies. And human capital, the stated most valuable asset, where's that? What is it? What is it everyone's spending all their time trying to attract in terms of talent if it doesn't really matter and it's not reported? Well, institutional investors have taken note of that. If you look at, and by the way, the history goes back much farther than this. We just have kind of the Cliff's Notes highlight here for you. In 2017, a group of institutional investors petitioned the SEC for, regulation or rules. Before that, there were white papers, by institutional investors saying, where's the workforce in corporate reporting? Sort of like, where's the beef in my, my hamburger? And then sustainability has really a wave that has caused a lot of organizations to actually voluntarily start disclosing a lot more. And then in December of 2018, there was a global human capital standard that came out from ISO, the International Organization for Standards. Really, that's the first true official piece of what we'd call GAAP, generally accepted accounting principles for HR, how to measure and report HR. What a concept, right? And then August of last year, the SEC made recommendations based on some of the proposals put forward by investors, and just this last month in August, made them official. So now we've given you a history lesson. What are you going to do about it? You ready to jump? So what does this mean for my organization? Well, it means somebody is going to be responsible for reporting or disclosing a lot more information about human capital, most likely. And I say HR someone because this is a very important inflection point, decision point for HR organizations, because if they don't do it, someone else will. And that would be a tragedy, because this information comes, almost exclusively and entirely from HR's type data. Of course, there's some options. You can do nothing. You can assess, you can prepare, you can plan to lead, and we'll talk more about those. But bottom line is, your choices will determine your path going forward in terms of organizations. And then all of this has been accelerated by the pandemic, which has been a human crisis as opposed to a financial crisis that the last financial crisis more than a decade ago was. All right, thank you, Carl. So,
really, when you think about it, it sounds like this is a required mandate that's coming on top of organizations. So tell us a little bit more about that.
Right. So the SEC, or Securities and Exchange Commission, which regulates all public listed companies and even some public listed, debt that private companies might place, has a set of rules that determine what companies have to report and disclose in their financials on a quarterly and annual basis. So they are the ones that are mandating all of this. And it went from the ISO standard that I mentioned earlier is something that's voluntary or recommended, but the SEC doesn't really do recommended. In this case, however, they did leave some important elements up to organizations. And the important elements are that each company must determine, as you can read right here, each company should determine whether or not talent, human capital, people, is material keyword accounting term, material to their business performance and success. The SEC didn't choose to make that determination for every company. They just said, if you make the determination, then you must report and disclose a lot more information about your talent or your human capital. Now, the SEC chairman himself did say in his own personal comments that I've never worked with a company for whom people weren't material, but each company must make their own decision independently. And that's basically option one. Option one is, we'll simply call it the high road. People are material, critical, of huge value to our business and business performance. So if that's the case, then you're going to need to go through each area of talent management. And given who we're talking to today, talent attraction, talent acquisition is definitely the kind of the leading edge of that, as well as training and development, retention, engagement, cost, productivity. You're going to have to go through every area of talent management and say what metrics are really important to our business that we use to run the business, and filling jobs and paying equitably and all of that would definitely qualify. Or you can take the low road, AKA the easy road. No, human capital is not material to our business performance. And we have no doubt some companies are going to take that road. It's the easy road. It's the low road. But there's a price. So Carl, if you could.
Yeah.
There we go. So if you take the low road, you don't have to report anything. And by the way, the only thing companies had to report previously was the number of employees. Now you wouldn't even have to do that. However, you got to have a muzzle or cut off the mic if your CEO happens to say, "Oh, our people are really our source of the." Oh, got to cut off the mic. They can't say that anymore. Can't say people are the most valuable asset. Can't say people are critical. Can't talk about diversity. Can't talk about pay equity. Can't talk about really anything people, because investors are going to go, "Well, hey, you just said they're not material. Why are we talking about it? You're wasting our time, and you certainly shouldn't be investing any money in this, foolish cost to be minimized." Not to mention, prepare for pushback from institutional investors are going to say, really? You also have a little bit of a built-in negative if you've made those comments in the past. Unfortunately, as we know with the internet and social media, things tend not to go away. So if you've been saying that all along, it's going to be a pretty hard sell to reverse course 180 degrees now. So you could end up with a lawsuit. You could get pushback from institutional investors or some other element in the mine field blowing up on you. So even though it's probably more work to take the high road, most organizations would probably say it's the better road to take.
Well, and just to kind of frame this too, you think about, like, there's different organizations. Think about a service organization like a hospitality or a hotel, which has, people is what makes their business. It's all about the service. Obviously they can't, if they choose option two, they're going to be in big trouble because
they can't
hide from that. But then, you have other organizations where you might have something that's created an app, or you've created, you're doing brokerage services. Think about like third-party logistics, small brokers. There might be three people in the company. All of their stuff, all of their business is done by brokering information back and forth. And so they don't have a lot of people to report on. It's a smaller business, so might be an issue.
Right, and bottom line, this is creating uncertainty and confusion in the market for companies today. That's for sure.
Yeah. Well, there's a lot of organizations that maybe are not tracking their people analytics in a formal or standardized way. So what are some of the what does this mean for them? What do they have to start thinking about in order to be able to comply with this regulation?
Yeah, that's a great question. And kind of back to that option one or two. So let's assume that you're choosing option one. And by the way, the majority of the Fortune 500, S&P 500, Global 2000 are. And most companies are actually disclosing more than the SEC has required in the past already in what they would call their sustainability reporting, their ESG reports, their integrated reports. So most companies were actually ahead of the basic SEC requirements. In fact, this year, for the first year, more than 50% of the Fortune 500 disclosed diversity data. And we know what a hot topic that is right now. So organizations are actually moving down this path already. But in this case, for those of you who aren't, you really need to get caught up. This is one of those things, and I've been talking to companies for years, decades in some cases, saying, "Oh yeah, we know, Jeff, this is really important. We're going to jump on it when it becomes real." Well, surprise, surprise, here in the pandemic, it became real. So really caught a lot of people, including myself, by surprise that the SEC decided to finalize this. So now you need to get started. In fact, this is effective in October of this year for reporting that comes in, and any public listed company reporting that comes in after that period. So you're going to need to start to be able to talk about it and report it. It's not going to be enough to say, oh, we invest in our talent. Oh, we treat our people so well. We have an amazing culture. Oh, we hire only the best in our industry. Investors are going to go, how do you measure that? What metric are you using?
Right.
Has it improved from last year? So a lot of the boilerplate sounds great to say language that companies have gotten used to using, they're going to have to reassess or back it up with numbers. And so, yeah, as you say, you're going to have to get your data in order to start with. Now, I would argue this is the equalizer for HR. Finance has always had the ability to kind of play trump cards and say, oh, we can't close the books. We can't do financial reporting. By the way, that was me in my old CFO days. If we don't get this system or tool, we can't do this. So I think this is actually a level setter for HR to get budget, get the resources, the people, the systems, the tools that they need to be able to do a much stronger job of reporting, because, hey, this is going to be going out to our stakeholders and investors. Speaking of maturity and where your company is at, related to the last question, where are you? Unaware. Well, hopefully now now you're aware. So we just moved you from level 1 to level 2. You're welcome. But just being aware isn't really enough. Obviously, your organization's going to have to start getting its data together, putting together a story. If you start to look at even level 3, full compliance, well, we've identified here are the 5 or the 15 metrics that are most important for our organization and our business. Today, that's really just entry into the door. You can't just hand the CEO, investor relations team a list of metrics and say, here you go. Good luck talking about that on the next quarterly call. No. You have to be able to answer the questions that come up with that and tell a story. Why is that metric important? How does it fit with the company's business and strategy going forward? And how will it fit for the future? How are we going to use it to create competitive advantage or sustainability and efficacy going forward as an organization, and show that we're not only taking care of our people, but delivering value for all the stakeholders as well as investors.
And Jeff, it sounds like this is really just for public companies, right? Or private companies have to do this too, if maybe they're a private company that's owned by private equity or investors?
Yes, so this is, the initial wave is all public listed companies. The second wave is probably going to be private equity or anyone who does any kind of institutional debt filing, things like that. So it's going to filter into private companies over time. And obviously the rules and requirements are much, much higher. The bar is much higher for the larger organizations as opposed to small to medium-sized businesses.
Got it. Well, that leads me to my next question here. Organizations that are kind of looking at complying with this law, what are some of the questions they need to be answered in order to be able to comply and be, have their house in order, so to speak, for this initiative?
Yeah, and a couple of good points here. The SEC requirements, as we said, this is just good reporting, and which, by the way, has been an ongoing struggle for HR ever since I've been in it for nearly 20 years. It's that part alone has been a struggle, but let's not lose sight of where we really want to take it. Once we have good data and good reporting, hey, now we can get into more advanced analytics. Now we can predict. Now we can simulate, model, and even prescribe. Once we know what drives a good effect, we can, create a prescription for more of the good stuff and less of the bad stuff. More training and career path growth and better quality talent and less, turnover, low engagement, and legal or employee relations issues. So on the left, you can see what, really some questions. Where are you today in terms of what your organization is disclosing? If you're a part of a public listed company, you might be surprised how much they're already disclosing. And again, as I said, the majority are actually disclosing some diversity data. But do you trust those metrics? Some of the best companies that we know that are doing really advanced reporting, by the way, they're not based in the US, they're outside the US, EU, and other countries are ahead of us. There was essentially an army of people in a room or series of rooms crunching in Excel and then turning it over to a graphics person to make beautiful charts out of the data. So it was a ton of work, and it was relatively manual, not a very sustainable process. So really, you're going to want to have your systems and tools in place and metrics, and track them, get some history on them. How are we performing? How are we sure do we trust that data? How are we sure that it's actually right? Can we drill down? Can we slice and dice it across geography and business segment and location? All of those items you're going to want to have nailed down.
Yeah, and I think, you brought up a good point on the systems. In today's world, a lot of employers have talent data in multiple systems, that maybe aren't talking to each other. There's, recently been more of a trend to try and get to the Workdays of the world that have everything all in one, more of an enterprise solution where you can pull data. But even they may have some reporting, challenges to get, if you want to link it to certain financial systems or integrate with things that maybe aren't as easily integrated. So having a systems lens is certainly something that we'll be talking further about here.
Yeah, and we don't have time to get into it, but yeah, talk about a miss. Some of the most valuable human capital talent data that exists is in applicant tracking systems. It's why you hired the person in the first place, why you pay them what you pay them. Then when you hire them, you take this snippet of data, this absolute bare minimum, put in your core system of record. What a travesty. You should be taking all of that data, basically a digitized resume, and capturing that, transitioning into your core systems of record, because that really codifies better than almost anything else the talent that you're bringing in. But enough said about that. Let's talk about the metrics for public reporting. Now, because the SEC, they did two things. One, they said each company has to make their own determination that human capital is material. Two, it's so funny. There's a great article out that says the SEC says human capital must be reported, but they didn't say what. So they did not mandate any specific metric. So each company has to figure out what they're going to report. Well, and so I have no doubt companies are going to come up with some very creative metrics around their talent to report. But the better way to do it, so if you're looking for a way to be someone who's bringing not only the, hey, did you know about this new SEC rule that's about to hit us like a wave, really some solutions, which is you can look at that ISO standard that I mentioned at the very beginning, which is the sort of the initial or the framework for gap accounting for HR. Really, how do you measure and report workforce data? And people data, talent data, you give it your human capital data, give it your own acronym. And these are 10 of the metrics that are in the ISO 30414 standard. There are 23 for public disclosure for large companies. A few of them are a little bit difficult, and you see some in the box that are additional, that are not as commonly measured today, but are going to be very soon. But you see some really good ones across the left side, top 10, and you also see some that are probably very familiar: quality of hire, time to fill. And it's actually, they have two metrics. Time to fill actually got two slots, one for average time to fill, how long positions are open, the second for high performers, because they understand that for critical roles, high performing positions, that's even more valuable and more sensitive. Literally, that's potentially lost revenue every day that those kinds of positions are open. So that's where you can actually positively, I would argue, affect the bottom line of your organization. By improving quality of hire, probably more likely to stay longer and do better, less likely to turn over, and time to fill.
I want to kind of zero in on that comment about quality of hire and human capital ROI. Those are two metrics that every organization that I've ever encountered have struggled to come up with a formula for. And I think that's where you have to be able to look at, okay, what's driving your business from a performance and revenue perspective on the human capital ROI percentage. So you have to have those data points pulled in and create, the analytics around that with a formula that's agreed upon. And then quality of hire, there's different drivers that factor into that. Could be performance, could be turnover. Again, it gets back
engagement.
There's a number of cross system and cross departmental factors and data points that you might have to pull in to be able to calculate quality of hire. So it may not be as easy as you think out of the box. So those are things that you want to kind of think through a little bit more thoroughly as you're embarking on this process. So now we get back to your comment about, have your systems in-house, and there's different ways people approach this. Obviously there's, the manual spreadsheet kind of model, and then there's the fully automated model, and there's systems that support both. So let's spend a little bit about, talking about these two options. Jeff, can you share a little bit more about pros and cons on both?
Sure. Well, like we said, you can always DIY it. You can do it yourself. Excel still the most widely used analytics tool in the world by far. You can use it. You can use Google. You can use a Smartsheet. And then you can take that and you can put it in a visualization tool like a Tableau, and I'm a big fan of Power BI, which I think is far better than Tableau, but Tableau is a great tool as well. Or you can develop some sort of script to build a little more of a process if you're taking data and you're doing some kind of repeatable reporting. And ultimately, that's what this is really all about. You need to get your data in order to build a repeatable process. Even if you're only going to report some of this human capital data publicly once a year or quarterly, it's still a ton of work. And so why do something manually when you can build a process that makes it better? That's why we have talent acquisition systems to really help us with the whole recruiting and hiring process. And even though it's a little bit more work to implement, it's a lot more accurate once you get it done. Because Excel, and still using Excel myself, but you're forgetting to tick one box, fill in one field, or change one variable from a completely messed up set of reports. And the last thing you want to be doing is pushing out material or metrics to the marketplace that are wrong. Not the best career move. So again, that's why we see really this going from a good thing, good to have, should have, every smart company is doing it or should be doing it, to a must have going forward in terms of having tools built into your systems. And I have no doubt that in time, the Workdays, ADPs, Oracles and SAPs of the world will have more of these metrics built in as sort of the standard around metrics and how they're calculated becomes more clear and more popularly accepted. But for now, really the best of breed tools are it. And in fact, the HCMI Solve tool, full disclosure that I've worked closely with my whole career and actually helped build, is the only fully ISO 30414 qualified tool to get you in compliance with ISO 30414, which in effect gets you in compliance with the new SEC mandate. But you can see all the considerations that need to go into it and really the pros and cons.
Yeah, and I think, when I've worked with clients and, we've looked at whether they have the capabilities in-house on the DIY versus purchasing a system, it's also a matter of, do you have people on your team that have the skills and experience to do some of the things on the left, with spreadsheet, advanced spreadsheet and analytics and Tableau, or people who can write custom developed reporting analytics in Python. Or if you don't have people on your team, but you're really an organization that's looking to use technology to enable your business and your decisions, certainly the side of you go with an analytics technology, either if you don't have the bigger enterprise systems, those that have best of breed point solutions where your recruiting is housed in an ATS and you've got a different HRIS and you have a different performance management system, something like Solve or Visio or PPL Insights are going to be a better solution as an overlay. It'll give you out of the box reporting and examples of some of the things that you can see. This is just a visual here. When you think about like best of breed of how Solve's product is set up, if you think about all those different systems at the top housing different people data, having a system that can pull all that information into one place and then give you a dashboard on the bottom to visually see your insights across all those different systems is a great way to be able to automate this and make it easy for people their information to be consumed and reported on to be compliant. This is an example of what a simple dashboard might look like, or what a Solve dashboard looks like here. It gives you both an executive level view as well as detailed analytics. And a couple other examples here. being able to quickly view your top and bottom locations for turnover and retention so that you can put action plans around, where do you need to put, where do you need to help some of the locations be better at retaining or recruiting talent.
Right. Yeah, I would call this root cause analysis because, again, if you can't just come up with a list of metrics and hand them to top management to report, they're going to want to know, well, why did this get worse year over year? Where did it get better anywhere or did it get worse everywhere? Give me the context, and why did this happen? Where is it happening? Is it all one story, or are there multiple stories behind it? And this is actually a great example. Who are the kind of the worst 25 in terms of retention and the best 25 in terms of retention? So you can segment and create what we call statistical term cohort, just groups, based on markets, geographies, performance specific metrics. And the idea, that's the advantage of a tool. That kind of slice and dice you just can't do usually when you're using Excel magic, right? You can get to the end result, but the drill down, slice and dice, root cause, and storytelling is challenging.
Yeah, I think the other advantage of tools like this is to be able to do what if scenario planning against historical data and predict out into the future, what's the forecast of the data. So, in addition, just being able to have the data in one place in a system to be able to print out a report or, provide it for your annual reporting compliance needs, to be able to do this during workforce planning and budgeting can be very, very powerful in terms of understanding where you have to put monies and, dollars and or effort to improve or decrease information.
Right. Yeah, workforce planning is my favorite area that links to talent acquisition because, Carl, you know why a whip makes the sound that it makes?
No.
Because the end of the whip is exceeding the speed of sound. So the end of the whip is going more than like 670 whatever miles per hour. Now, and I would say, imagine when your CEO goes, we just need to do this, a whip in their hand, and they flip the whip. Recruiting is the end of the whip. So what happens is, when you're in a pandemic or you're slow down, we don't need to recruit. Why do we have all these recruiters? We don't need them. They're all good for nothing, et cetera, et cetera. But when you're in growth mode, it's why can't they fill those positions? We need people yesterday. It's literally nothing but a world of extremes in recruiting and talent acquisition, because basically you're, why are you here? I'm not sure we need you, or you're taking too long, or even worse, you're getting the positions, the butts in the seats fast, but, what we really need is quality of hires. You're giving us crappy people. Really? So if you had the ability to forecast and anticipate and could, so to speak, educate the customers and the clients on that, then you can hopefully be, one, pressing them for successors, and two, driving a little accountability backward into their arms that, hey, how come you don't have any successors? Okay, you want me to take care of it? Okay, well, we know this position, or we know we're going to have approximately 20 accountants leave next year. Why don't we build a pipeline of sort of pre-qualified, like real estate, right? They're pre-qualified. They like us. We've interviewed them. We already know that they'd be a good cultural fit. As soon as the positions open up, we're sending the email, making the phone call, and they're hopefully putting in notice and signing an offer letter so that we can fill that position as quickly as possible. There's so much you can do if you can anticipate, and a lot of that comes with forecasting and workforce planning.
Absolutely. Very powerful stuff. So our last question here, what are some of the positives or additional benefits that employers may gain from having to comply with this new mandate?
Right. As a former CFO, the last thing I ever wanted was more SEC rules and reporting and mandates. But that said, this is an area where there's been a lot of fits and starts, right? We need to get our technology in order. You buy a new system to process transactions, but then the data goes, like talent acquisition is a perfect example. Most of the data is underutilized, even wasted. So you have all this, you're like in West Texas, like, we have all this black stuff bubbling up out of the ground. Please, somebody come take it away. Oh, it's crude oil worth millions. Can somebody turn that into something for me? Yeah. So that data is so valuable. So if you can capture it and put it in a system and a tool, you can use it for there you go. All kinds of slicing and dicing, geographic, and really getting into what we would call quality of hire. That's the penultimate. That's the ultimate level for talent acquisition. You don't want to just be filling positions. You want to be filling positions with better quality people who are going to perform better, stay longer, be a better cultural fit, all that. Well, what if you had, and again, it's what we call an index metric, a set of related metrics that combined with a weighting give you an insight on more of a holistic 360-degree insight around your talent. And you could even monetize it. Not only can we measure what is our quality of hire score, and at the end of the day, all we want to do is improve it. If we can improve it 1, 2, 3 percentage points a year, that's awesome. But how much is that worth? What's it creating for us in terms of better retention, more highly engaged workers, more ability to grow talent internally instead of always relying on, fill and fill tomorrow type of, especially for really hard to fill type roles where there's tremendous pressure on talent acquisition. It really makes for the win-win-win situation for organizations if they can get there.
Well, and I think in today's climate, a lot of organizations are trying to up their game in terms of also looking at the ROI and their performance around diversity in their organization. How are they how well are they doing in diversity recruitment? And is there a correlation between the people they hire to the performance of the business? Right. And having these kinds of analytics and tools and having a lens on analytics in your business can really help you determine, yes, in fact, there is a correlation between the top performing stores in your business actually have the most diverse people in the business.
Right, and we've actually had case studies that have turned out that the best performing, often locations, stores, geographies often have leaders who have a more diverse team, or they have just plain more diverse groups and teams. And if that's the case, why aren't we doing it? Because it's not just, as I said before, more than half of Fortune 500 companies are already reporting voluntarily more diversity data. But the real challenge is once you report that data, your own CEO, your board, and let alone your your investors are going to say, what are we doing about it? How are we going to improve it? And that is the challenge. By the way, again, talk about another crack of the recruiting and talent acquisition whip, right? Recruiting, we need more diverse candidates, more highly qualified, super experienced. Like there aren't that many, but hey, we need them anyway. Well, what if you had the market data to show where you can get it or where you can't get it, so you can get the conversation and manage expectations? Or better yet, what if you could actually show that, just a bigger pipeline of diverse candidates and hires isn't really the solution because they all leave, right? Because our culture, our onboarding, and our career pathing are impediments to that. And this is the kind of root cause analysis that you can and should be doing. So again, point for about the 5th time, it's not enough just to measure. You really have to be able to story tell and get the context around it to solve the problems.
Yeah, I think you hit some really good points there. It's about telling a story for the business, and by having these mandates, it's a signal to the business, hey, let's get more robust and let's get things tightened up around this. Let's build a culture around people analytics. Let's make sure we have talent in our business, in HR and in recruiting, who have some analytics competencies. Just to put some trends up here as kind of a wrap up here before we go into Q&A. There's some data points here that came out earlier this year that over 85% of HR professionals surveyed feel people analytics is a top trend in their business in 2020. Now, obviously, COVID threw a wrench in some of that. Maybe, they may not have as many people to report on, but hopefully it'll be a big swing back when all this kind of goes away and goes back to somewhat of a normalcy. And I really see an increase overall just in people that are starting to go out and seek out analytics, training, certification, and competencies to add to their HR and recruiting resumes. So anybody on the call that, is thinking that this might be good for the resume build, absolutely. This is a trend. This is something companies are looking for. Be proactive and be prepared as part of your career development than just be reactive and only do it when you're asked to do it, because people who have it are going to be more in demand when you're competing for that next job as you go out to market. So with that, I guess before we break to Q&A, Jeff, any final words on all of this for people on the call, and then we'll jump into Q&A here?
Sure. The war for talent is not over. It just took a breather, right? You can have warring armies, but when there's a big forest fire, everyone's going to run. So the war for talent is just on pause. It's coming back as soon as the pandemic settles, and the landscape is going to be dramatically different, right? Remember, geography used to be such a huge issue. We need people who are like here and here and here. Well, not for a lot of companies. So now your talent acquisition landscape, probably scope just got a lot bigger, but so did your opportunities if you can get the right data and the right potential to tap these larger geographic markets to find, so to speak. What I would argue, you can actually, if you're really, really good at this, you can potentially get better talent that even costs less. Paying more doesn't necessarily guarantee you get more. I know in recruiting and talent acquisition, we like to think, well, if we pay more, that means we get more. No, it just guarantees that we pay more. Unless you've got some secret sauce around quality, in which case maybe you can get both. But there are ways where you can find geographically better talent that's at a very reasonable price. And when you can get that, that's, sort of speak, hitting the gold mine, or the oil, data being the new oil, to help you do your job and be a wildly successful hero in, so to speak, winning the talent war.
You brought up a great point on that. With today's more virtual world, I've known a number of people who have decided, hey, if I don't need to be here, my company's made a decision to make my job more virtual, I can actually go and live where my sister-in-law lives in a warmer climate and not have to deal with the snow that's going to be hitting us in the Northeast. And so, maybe where they're moving to and where they're working in the future is going to be in a lower cost market. So employers who have that market intel overlaid with their recruiting data will have the golden carrot for being able to zero in on where they can get the best talent in the least expensive markets. So another great insight in terms of how data can help in the recruiting process. So I'm going to wrap now. This is where we're going to turn it over to William to run the Q&A session here. And William, thank you.
Thanks, Carl. So yes, we have a few good questions here. Evelyn asks, does the new SEC rule require reporting for publicly held companies apply to FTE employees only, or is a company required to report on contingent workforce too?
Oh, great question. So, and a tricky one. So I'll try to give you my best really short answer. So if two answers. One, it's up to the company's determination, right? You're going to have to choose, each company's going to have to choose, okay, here's what we are doing, but it comes back to that materiality. Now, if you're like many large companies, Google, Microsoft, others, and half of your workforce is contingent, you've got to report it because it's material. It's half. You've said, okay, people are our most valuable asset. People are material. Well, half of it is contingent. So now you need to include that, which is going to be a big chunk of work for a lot of organizations. You got great data on your employees and often really spotty data on your contingent workers. Also, if you go to the ISO standard, which we're recommending is kind of a safe haven, that ISO 30414 standard, that also recommends that you report employee workforce, full-time equivalent workers, and contingent workforce, both the number and cost. So it'll be interesting to see what companies come up with first out of the gate on this, but I suspect where it's going to end up pretty quickly is that companies are going to have to report and disclose their contingent workers, which is probably today the single biggest thing companies don't want to disclose, how many contingent workers they have.
Okay, great. Another question here goes to the earlier portion of the webinar. How does one hold companies accountable when they say human capital is not material to their business? Isn't it just cost less to change verbiage in the reporting than to actual go into human capital? What would one of these lawsuits look like? I guess we got a future activist here asking this question, but would you see perhaps taking shape as far as people that go around challenging whether people are complying or being forthcoming?
Yeah, I love it. So I hear a little bit of why should we in there. And I totally get that. And remember, as a former CFO, the last thing I wanted was additional workload to measure, additional metrics to measure and report. But at the end of the day, we all know, everyone's bought into, there's a ton of research that people really are the differentiator in any organization. So, however, what happens if you decide to take the low road? Well, institutional shareholders. So I'll give you a couple of quick facts. So institutional shareholders, the US holds about $100 trillion of the $200 trillion in wealth in the globe. So we have about half the wealth of the world in the US alone. When you add in kind of some of your allied, closely allied English-speaking nations, you're probably at about 65%, 70%. Institutional investors, basically think of it pension funds, very large asset managers like BlackRock, hold the majority of that value. So and the stock market, besides real estate, the two biggest things are real estate and equity markets, and bond and debt markets as well. But if essentially the owner of your public listed company, or someone who owns 25% of it, and it's probably a group of institutional investors, they say, I'd like to see this, they're the owners, I wouldn't bet against them. They're going to get what they want. And those would be the first ones that are going to push back. They've all been waiting for years for this to happen. They've all got copies of the ISO standard. They've all got copies of the SEC rulings. They've got all kinds of other studies armed with. So I think they're just waiting for the next quarterly calls to start asking a few questions. Well, what are you doing to improve the culture there, as well as, safety and efficacy? And what about your essential workers? Are you treating them any different? There's going to be a lot of questions that will come and potential pushback. Secondarily, if you have a history of saying all these things about people and now you're going to strike it. Oh, by the way, in your risk statements, companies have tons of risk items that they list in their legal risk section around human capital risk. If you say that people aren't material, you have to take all those risk factors out. If anything there goes south, like you get a lawsuit, any kind of a class action, you have a sexual harassment claims, any of this stuff goes public in social media, you're just begging for some activist investor to come say, they lied about their disclosures. They're misleading investors, and start rallying people for, basically a big payday because the company chose to take a low road rather than a high road.
Okay, great. Further question about clarifying that this does apply to publicly held companies. Is it just only U.S. operations? Is this international? Do we have any borders or oceans that hem this in at all?
Great question. So and it's a little tricky, but I'll make it really simple. Any organization that lists their shares in U.S. markets. So believe it or not, most of the global 1,000 largest companies in the world do list their shares in U.S. exchanges. Why? Because it's the biggest marketplace in the world and holds, as we just said, 50% of the global wealth. So companies like Allianz, Deutsche Bank, and others, they have what's called ADRs. They have listed shares in U.S. markets to make it easier to trade their stocks without having to go to their local country exchanges. So for any country that lists shares in any way, shape, or form in the U.S., they need to comply.
Okay, great. What about teeth for this reporting mandate? What if people don't comply? Is there anything financial or otherwise besides, shareholders getting upset and grabbing pitchforks? Is there anything from a penalty phase or criminal aspect that could come down to this?
Not at this point. In fact, I would argue that if one of our recommendations is you can kind of go for the Gold Cup trophy by choosing to disclose more and be more transparent than everyone else, or you can do a middle ground and say, we're going to report all the metrics that we can kind of readily get access to. We have a reasonable level of confidence, and we'll be honest with the rest. And that's what I would encourage for some companies. Say, look, our systems and data are not quite ready. We need a little more time. We're studying this. We're building it. We will be reporting it or disclosing it, at some point in the reasonable future. So you can always, now is the time you can get a pass because there are no penalties or criminal crimes for any of that. But by the way, you might be interested to know that there are bills in both houses of Congress that are much more stringent than what the SEC just mandated. They would both mandate specific metrics that must be reported for organizations, that depending on how things go, I would argue that actually regardless of the outcome of the election, one of these bills will probably, or some variation of it, will probably turn into law next year, given the whole movement around multi-stakeholder capitalism, really the human crisis that is the pandemic and coronavirus, and the overall, just the global warming trends and the big push on diversity. Really, organizations, I think, as much or perhaps more than any point in history, are going to want to do the right thing. They're just going to want to be careful what they report and disclose. So this isn't like disclose everything and and kind of go, full full open kimono. And it's really, let's report what we've got a handle on, and then let's report other things as we get comfortable with them.
Okay, great. And if I can ask you to put your predicting cap on there, Jeff, how would you see this impacting talent acquisition or HR, as far as needing to work more with the investor relations and being able to, besides just implementing the ability to report, how do you see this impacting the working relationship or even structures of HR going forward?
Oh, great question. So this is a watershed. This is a sea change moment for HR. You get an equal, and I would argue, forget whether or not HR has a seat at the table. I would argue this is the path to a bigger and better seat at the table. Maybe you can even displace finance kind of on the right-hand side of the CEO. Because you're now going to be, you have always been really the stewards of the most valuable asset that the company has, which is their people, their talent, their human capital. And I think in the future, every CHRO will be SEC and human capital metrics literate, just like every CFO is today for public listed companies. The option to kind of, gee, I don't know this whole metrics thing, I don't get. Not if you're a public listed CHRO. This is a path to for more analytically, numerically oriented people in HR to really tremendous success. The HR data scientist, analytics person, analyst, I think is going to have a huge new opportunity. And the single biggest source of valuable data is probably talent acquisition, which is, what is it all about the people that we're bringing in that's so valuable? That's a gold mine of data, talent, and value. So I think that and I also think in the future, there'll be a much bigger budget for HR. There'll be more credibility and respect for HR as a part of this disclosure. And I think people like, my kids or grandkids are going to look and say, Grandpa, how did companies work before they had to just, how did things work before companies had to just, I can't imagine that they didn't disclose their talent data and their greater level of transparency. There must have been a lot of bad things happening, in those times, or did companies, were they efficient back then? And say, oh yeah, lots of bad stuff happening. But bad things happen in a dark room because you can't see it. And transparency solves a lot of problems, right? You measure it, you can manage it and fix it. And so I would argue that organizations and HR's inability or lack of desire to measure things has been its own worst enemy. Yeah, it's a lot of work, but you know what? You can't solve a problem if you can't get your arms around it.
Great. Well, Jeff and Carl, thank you for being with us here today. Really appreciate the time, the thought, and taking these questions here. As shared earlier, an email will be sent out to everybody who's registered for today's webinar. It will include a link to the video recording, as well as have attached a PDF version of the slide deck. So please be on the lookout for that a little bit later this week in your inbox. Just forecasting a little bit ahead into October, we do have 2 webinars on deck for you to be looking for to put on your calendar. The first one will be posted shortly. It's not quite publicly available, but we'll have posted. It'll be for the 22nd. It'll be talk about what to do with regards to high volume and hourly recruiting. We're going to tackle that part of the marketplace in light of COVID and what does 2021 look like. And then on the 29th of October, we asked the question of how veteran ready is your organization ahead of Veterans Day. So please go to atapglobal.org under the Learning tab in the upper right-hand corner and pull that down and select webinars to register for either of those events. While there, please consider renewing or joining ATAP. We'd, again, love to have you as part of this organization as a volunteer or helping out in one of the council's works, whether it's standards or events or marketing. We would really appreciate your ideas and your help. We'd also like to get feedback on this webinar event, so please be on the lookout for a separate email with a link to a short survey. We do incorporate your ideas and thoughts and feedback for future events. Otherwise, thank you for being here today. Have a great week. Take care, folks.
Thanks, William.
Thank you.